Hello and welcome to Macrobytes, the economic and politics podcast series from Aberdeen. My name is Luke Bartholomew, and today we will be talking about China, and in particular, the shifting regulatory sands around the real estate, technology, and education sectors, where, as I say, sweeping changes in these areas stunned investors through 2021 and saw significant market hits, market capitalization of various big firms reduced by something like $1 trillion. And the sweepingness of these changes, combined with increased rhetoric from senior Communist Party officials around common prosperity, has divided commentators, investors, analysts as they try to work out the motivations and exactly what's going on. Have some people arguing that this is all about domestic and global politics, the Communist Party trying to shore up its domestic power base and to buttress against potential global threats, whilst others see these as justifiable interventions to tackle market competition issues, systemic risk issues, and perhaps to deal with various inequality concerns as well. So to help us navigate through these various arguments, I'm delighted to say I am joined today by Paul Lukaczewski, who's our head of corporate debt Asia Pacific, and Bob Gilhui, who's a senior emerging market economist and is just completing an extensive research project around Chinese regulatory policy. So I can think of no better guests to help us with these issues. So I think we'll start with the real estate sector, which, given the importance of real estate in the Chinese economy and driving growth, and also the nexus of links between banks, developers, local governments, creating potential pillars of vulnerability, which, if toppled, could engender sort of cascading defaults and systemic risks. This has been always an important sector for global investors, but especially so in the last few months as the trials of Evergrande has been sort of top of headlines. Evergrande, this is China's highly indebted real estate developer. So Paul, maybe starting with you, I mean, markets still seem to be pricing in a pretty high degree of systemic risk around real estate developers and these issues in general. So perhaps you can start us off by just telling us how you see these issues and sort of how the market's been weighing them up.
Thanks very much, Luke. Thank you for having me with you today. I think before we get into the specifics, it is important to have a little bit of context about what is happening in China and in this in the property sector specifically. You know, you mentioned the common prosperity rhetoric. If we take a look at the property sector itself, the kind of the phrase that has been coming from regulators now for several years is that housing is for living. Which very much aligns with that common prosperity theme. If you ask where we stand on the issue, we think it's much more sort of the latter of the two alternatives you presented. That this is a pivot by China to a strategic pivot in terms of the shape and direction of the domestic economy to support stronger long-term growth. And that is obviously coming at the expense of some near-term volatility. But it is very much about, you know, preserving opportunity and equality, especially for China's middle class. It's about tackling income inequality, unfair competition practices, and issues of that sort. And with the property sector, so obviously, one, it is meant to tramp down speculation. It's meant to tramp down, again, runaway property prices. To again preserve that sort of that opportunity for China's middle class, but importantly, it is also one of trying to contain the risks to the domestic economy, because the property sector is so important to it. But as you mentioned in your question, right, there's still quite a lot of risk that is being reflected in markets at the moment. You know, China single B spreads in the dollar market, you know, are at sort of a 3,500 basis point kind of level, which implies a 50% default rate. Now that's on top of, you know, all of the most troubled developers that have long since been downgraded to triple C territory. And really where we are now is you know, for Asia's entire offshore credit market, the implication is that we'll have a default rate probably between 10 and 20%, which will be historic. We've never seen levels like that in the history of this market before. Now, the reason for that is it is a developing market, and the property sector is quite important to it, especially in the high yield market where obviously this default rate applies to. China property developers account for about 40% of the market. So given the stress in that sector in particular, that is why we see such exaggerated impacts on the market as a whole. Without rambling on for too long, the systemic risk really is one of the complexity of the issue. We've had central policy sort of steer towards tightening and promoting de-risking of developers, and we've seen rising investor risk aversion translate into significant drops in bond prices as investors are losing confidence that builders will be able to refinance their debt. Now, what's really exacerbated the issue in the last couple of months has been that zealous local regulators and bankers are reacting to the stresses they see by further constraining each developer's liquidity. They're basically locking cash in project accounts and not allowing developers to access that. And so where the central government policy is I think increasingly pivoting towards promoting stability and perhaps recognizing that it may have gone a bit too far. Unfortunately, the coordination down to the local level hasn't quite reconciled the liquidity problem, and in some respects is actually fueling even greater stress at the moment.
I take the point there about the tackling of systemic issues, and perhaps central policymakers are starting to favor a bit more stability at the moment. But have we been perhaps surprised by maybe the sense that policymakers are underestimating the squeeze that they've put on the real estate sector, or perhaps the slowness in response from policymakers?
Yes, in a word, yes. I think we are surprised. We're surprised the crisis has been allowed to reach the level it's reached. To kind of highlight a few statistics, the property sector is estimated to contribute between 20 to 30% of China's GDP. Importantly, it also represents about 70% of household wealth. It's the number one store of value for Chinese citizens, and lastly, it's also a key revenue source for local governments. Again, representing usually about 30% of revenues for local governments. Local governments via land sales, which go to developers. So those developers need to be healthy and able and willing to buy more land. So with all of these pressure points and stress points, it has been surprising to us that the crisis was allowed to reach the levels it has, and certainly it seemed like regulators were a bit passive and not quite recognizing the severity of the problem that had been triggered. A statistic we came up with back in September was that 25% of the sector by property sales transactions, so of the entire domestic property market in China, was accounted for by builders who had at least $1 bond with a yield of 20% or more. Now that's that's a statistic that basically tells you the market's saying that those builders cannot refinance their debts, and so that's a quarter of the industry, and things have only really gotten worse with the liquidity squeeze that's materialized since then. So if we think about ramifications, and as Donald Rumsfeld once talked about the known unknowns and the unknown unknowns, I think if we trigger the consumer confidence hit and the potential repercussions you could have across the economy if you saw that much destruction, whether it was loss of employment, falling housing prices, and just general rattling of consumer confidence, certainly that's, I think, a pretty large unknown. And hence, we do find ourselves surprised that for a government that values stability, that things have reached the position they're in. But importantly, we do believe that the tide is clearly turning, and that regulators have woken up to the issue.
Well, let's leave property there for now and move into the technology sector, because I guess, as you say, what's interesting about real estate are these clear financial stability risks that might make sense to tackle. In the technology sector, there's sort of potentially more issues at stake around competition policy, national security, geopolitics, and indeed regulators and governments across the world are trying to figure out how they want to regulate and deal with the tech sector. So Bob, bringing you in here, I wonder, have we seen a new approach from China recently, a more prioritization around dealing with things quickly?
Yeah, I think potentially yes. We are maybe kind of seeing this kind of speed take precedence. And while China is probably kind of at the more extreme end of this, I would say it's maybe not just a kind of China story when we look at regulations around the world. There does seem to be a kind of growing recognition internationally that intervention in technology firms needs to be a bit more responsive, forward-looking. Competition authorities around the world seem to be kind of struggling, if you will, to apply conventional regulatory frameworks to technology firms. For example, antitrust traditionally is focused on uncompetitive price setting, has required regulators to define the impacted markets. But the rise of zero-cost products, the powerful network effects that can lead to this sort of winner-takes-most landscape dominated by a few large tech firms, and these are large tech firm dominating the landscape, but still exerting downward pressure on goods prices. This really means that kind of pricing alone is often a kind of insufficient criteria which to judge competition and antitrust. So this does seem to be, I think, shifting regulators, not just in China, towards a kind of ex-ante assessment, thinking about how competition might be affected rather than waiting for clear evidence. So in that sense, China steps are probably a bit more aggressive, but they're not necessarily kind of at odds with these embryonic global trends. And indeed, the EU's competition chief, Margrethe Vestager, recently said, it's better to get 80% now than 100% never. And you might think as well that there's potentially advantages of moving fast in an emerging market context versus a kind of DM context. So emerging markets might be starting kind of further from best practice. So potentially it's more effective to kind of get the regulatory perimeter kind of back up to kind of where it should be when your economy's undergoing a lot of structural change and more just kind of growing fast. I mean, of course, that's not to say that moving fast is not without quite a lot of risks. Moving fast is likely to keep investors fairly on edge. Policy uncertainty can definitely be amplified, particularly if there's concerns about property rights, regulations not operating necessarily in a solid legal framework, and if there's kind of few recourse opportunities as well. So this kind of opaque decision-making process can make everything kind of seem like there's much more unpredictable shifts in the regulations going on.
So we've talked there about the competition policy aspect of this and the reasons why one might want to move quickly on the basis of competition-based reasons. But I'm wondering sort of what other factors might also be at play in terms of motivating the intervention in the technology sector. I mean, how much is politics, both domestically and internationally, playing a role in this, do you think?
Yeah, I mean, there's definitely a few kind of interrelated factors there. I mean, first of all, I'd probably break it into two. So I'd say, like property, financial stability has definitely been the motivation for some of the interventions within technology. Fintech regulation was initially very light touch in the early days. The state council saw advantages in increasing financial inclusion, helping kind of motivate and spur change within other financial firms. But this kind of unfettered fintech innovation, I think, is beginning to look quite a lot more like regulatory arbitrage, and that sat quite uneasily with the kind of ongoing de-risking campaign, which began in 2017 with this kind of crackdown on shadow banking. And then, turning to politics, I think one can't fully discount the kind of domestic political motivations. Large technology firms were clearly a key component in keeping China, in fact, most countries around the world, running through the COVID-19 shock. Government did find it needed these firm systems to track and trace as part of its zero COVID strategy. So this kind of rise, if you will, in economic and political power potentially, could have raised eyebrows in Beijing. Obviously, we had the torpedoing of the Ant Financial IPO. That certainly made it seem, I think, initially like power politics was part of the story. But as we kind of progressed through the year, I think this clearly broadened out beyond Ant. CBIRC noted there's problems with regulatory arbitrage were not just an Ant financial issue. The state Administration for Markets and Regulation reportedly summoned about 30 internet firms, admonishing them for a kind of range of business practices too. But I think this is kind of broadly consistent with the notion that the authorities were motivated by kind of domestic factors, competition as well. I would, though, throw domestic I'll throw geopolitics into the mix here. So while I put more emphasis on the kind of competition angles, dealing with FS risks around fintech, I think it is important to acknowledge that geopolitics has been an influence on some of the interventions within technology. So China's new data security law is a good example. So this law governs how data is stored and transferred. In this regard, it's quite similar to the EU's GDPR, but it also introduces security-related classifications of important data and national core data. So these are effectively tough conditions on the ability of firms to transfer data abroad. Firms that are deemed what are called critical information infrastructure operators, which includes communications, IT, finance, and energy, required to store data in China and must undergo effectively like a security assessment by the Cyberspace Administration of China for data transfers out. And this kind of seems much more like essentially just a drag on firms rather than kind of being motivated by market failure per se. So much more about the kind of geopolitics, national security there.
Brilliant. And so moving on to our final sector of education, where the intervention there seems to be less about market failure and potentially more in line with the common prosperity rhetoric around what at least you can make an argument around tackling inequalities. Certainly the effective shutting down of the private education system, I think, came as quite a shock to a lot of investors. So Bob, why don't you start by just sort of reminding us what's happened in that sector and why?
Yeah. Okay. Yeah. Thanks. I mean, the what is, I guess, kind of relatively straightforward. So we'd had some, I guess, if you will, murmurs of discontent from the authorities about the private education sector. Ministry of Education had criticised the kind of flood of money into the sector and the pressure that it was seemingly putting on parents to sign up their kids for tutoring service. But the effective shutdown, a $70 billion sort of industry was much more than expected. So new academic tutoring firms will no longer be approved. Existing companies are being forced to convert into non-profit entities, and tutoring firms can't raise any money on the stock market or indeed accept any foreign investment. So, the more extreme commentators out there really kind of questioning there's some sort of beginning of the end of Chinese capitalism. I think maybe the more interesting, now we wouldn't agree with that, but the more interesting, I think, is kind of the why, and that's probably a bit more complicated too. So it seems to us that Communist Party concern about the pressures which households face from the likes of high housing costs, long work hours, and then juggling childcare seem to be kind of intersecting with this growing disquiet or concern about declining fertility rates and the rapid aging of the population. So China's births fell very notably in 2020 when we had the latest census. Very much likely that year was due to the COVID crisis, but births also fell quite notably in the previous 3 years. And if we use the UN's population projections, the economic implications of kind of following into a low fertility path are huge. So by the end of this century, working age population in China, if we follow this low fertility path, could be around about 250 million lower than if fertility holds up. And then, as you said, it's probably better to think about this kind of through the common prosperity lens, an attempt to kind of resolve a social failure with the externality in this case being kind of falling population and falling economic might that it might imply. Indeed, I think kind of viewed in this way, this kind of heavy-handed approach could potentially be kind of thought of as needed to break this socially suboptimal equilibrium. So the knowledge that other parents are motivated to pay for tutoring to give their children an edge leads everyone to demand it. So we kind of end up the educational equivalents of sort of game theory's prisoner's dilemma.
Well, so on that note, I mean, do you think this policy does tackle the root cause of the problem? And to use that game theory language, is this a stable equilibrium, do we think?
Probably not. I mean, the Chinese Communist Party certainly prizes stability, and maybe this is just kind of some first steps in trying to get at the root cause of the problems. But I think our analysis to date suggests no. So private tutoring, which reportedly costs around about 10 times as much, could take the place of provision by firms. So that could potentially exacerbate inequality of opportunity. Competitive pressures to excel academia, I think, risks maybe putting more burden on parents. That's a potentially less efficient source of teaching. I think most parents who've had to endure homeschooling through COVID lockdowns would likely agree with that. And then kind of more seriously, one could also argue that it could perpetuate, I guess, a kind of inequality of educational opportunity across the generations. Put simply, those who've got well-educated parents might therefore kind of have better chances to get into university. So, overall, I'd be a bit more confident that this was going to be durable if it was coinciding with more fundamental change within education. So there's not yet really any signs of changes to the tough university entrance exams. And then I guess international examples as well of trying to deal with the symptoms rather than the root cause are not particularly encouraging either. So Korea's attempts to ban tutoring in the early 1980s was also billed as an attempt to ease pressure on students in its kind of similarly competitive educational environment. However, and I quote, underground tutoring eventually led the government to kind of roll back on its restrictions. And here I always kind of imagine this underground tutoring club as somewhat like Fight Club, but more chalk and algebra and less punching.
Well, that's probably an excellent note to end our topic on education then. So perhaps just to wrap us up, Paul, I mean, I said at the start that these regulatory changes have sort of been quite a significant shock to markets over this year, wiped off a lot of value. I mean, how are we seeing things going forward from here? I mean, is there a possibility of positive regulatory surprises?
Yeah, no, thanks, Luke. As I alluded to in my earlier remarks, I think we are on that path to stabilization now. At least specifically with the property sector, which is the sector that's sort of most dislocated in the eyes of markets at the moment. If we look back over the last year, the tightening cycle has largely been in place for a few years. Especially if we set aside temporary loosening that came in response to the original COVID shock in 2020. But otherwise, the direction of travel has very much been on tightening. Most clearly seen in the 3 red lines policy, a bit less underappreciated by many, but there's also a similar 2 red lines policy for banks with respect to their lending to developers. So that's been sort of the tightening stance. But what we've seen in recent months is a very clear transition towards seeking to I think de-risk what's happening in markets at the moment. From a central government level, we've seen clear uptick in terms of engagement with various stakeholders, whether it's local regulators, whether it's ratings agencies, market participants, or developers themselves. But we're seeing a lot more engagement from authority figures on that front. We're seeing the PBOC, for example, target specifically improving mortgage financing as well as pushing banks to restore lending to the sector. We've had reports of the 3 red lines calculations to specifically be amended to exclude M&A lending. That's important because it could provide a potential pathway for asset sales and encourage a degree of consolidation driven by the larger, more stable names. And then lastly, and probably most importantly, what we have is right now is sort of a negative feedback loop, and that negative feedback loop is concerned about builders' ability and willingness to repay their debts as they come due. And we've seen regulators try to adopt the playbook they employed back in 2018, where we had a similar crisis of a smaller scale, in that they're targeting reopening financing channels for developers onshore. We've seen reports, in particular, the promotion of allowing higher quality builders to access the interbank bond market onshore. And most recently, we've also seen a notable push and uptake in terms of ABS financing for developers as well. So, those are 2 key channels, and really for the sector to normalize, it's important for market participants to see a way out of it, to see that builders can, manage their debts as they come due while they maintain themselves on a path to deleveraging and de-risking. But the second part of the equation is also the self-help side, where corporates aren't standing idly by either. And just to give examples, but we've seen equity raises, we've seen asset sales, we've seen sort of creative financing transactions, and we've seen corporate actions, or let's call it creative liability management, where builders are recognizing that perhaps their current creditors are their best source of financing for the time being, and so looking to find creative ways to extend their maturity profiles to avoid defaulting in the near term. So all of these things, have kind of clearly brought us in from the wides, from kind of the wides we saw about a month ago. But that said, as I mentioned, we're still in a market that's pricing in just a historic level of defaults. So there's clearly, we're still in a very fragile state, and I think the momentum needs to be maintained, because otherwise we are facing more default events in the near term, and potentially more volatility if regulators don't continue to find ways to cushion the downside here.
Super. So I think that is all we have time for this week. So thank you so much to Paul and Bob for joining us and providing their excellent insights. As I said, we will be releasing an extensive research series on this topic. So please do look out for that, and please do like, subscribe, and comment on the podcast in your preferred podcast provider. And all that remains for me to say then is thanks very much for listening, and speak to you again soon. Thank you very much.
This podcast is provided for general information only and assumes a certain level of knowledge of financial markets. It is provided for informational purposes only and should not be considered as an offer, investment recommendation, or solicitation to deal in any of the investments or products mentioned herein, and does not constitute investment research. The views in this podcast are those of the contributors at the time of publication and do not necessarily reflect those of Aberdeen. The companies discussed in this podcast have been selected for illustrative purposes only, or to demonstrate our investment management style, and not as an investment recommendation or indication of their future performance. The value of investments and the income from them can go down as well as up, and investors may get back less than the amount invested. Past performance is not a guide to future returns, return projections, or estimates, and provide no guarantee of future results.